The volatility smile is a long observed real-life pattern where at the money options tend to have lower implied volatility than in the money options and out of the money options. That applies for both put and call options. The pattern displays different characteristics for different markets and results from the probability of extreme moves. These are patterns that aren't expected to happen based on the theory of the Black-Scholes model.
Black-Scholes model is a very interesting measure that allows us to value and give a price to a certain option. Black-Scholes model also proposes us it lets us know by D1 and D2 values what is the probability of a price of a stock to fall under a certain interval of prices. But there is also something more interesting, which is that Black-Scholes model takes volatility as a constant along all of the options that are being analyzed, because it says that the underlying asset is the same for all, so it tells that all the volatilities should be the same, which is something good in the theoretical point of view, but in practice things are very different. Stock prices tend to behave different than what Black-Scholes is expecting on the model. Stock prices, being the underlying assets, have the tendency to not being aligned in a log normal distribution. They are more aligned in a distribution that the tails of those distributions usually are bigger. And these bigger tails, what say is that stock prices can fluctuate from very high prices or to very low prices. So these effects of implied volatility are what we can see on a volatility smile. So the volatility smile offers us 2 points of view, one that is at the money and one that is in the money or out of the money. So when the strike price is at the money, when the stock price is at the money, we can see that volatilities are not very high. But when the strike price starts to go on the money or in the money, when the strike price doesn't move, but the stock prices is moving and giving the opportunity to be out of the money or in the money, then the volatility starts to become higher. And this is what we can see in a volatility smile.
Well, now we're going to expose this theme that we talk about the volatility smile in the code. First, we install the packages and the libraries, and we took the data and the information from Yahoo Finance, and these are of Microsoft. Then what we put here is that we are going to use the Black-Scholes model to determine the volatility and the graphic of the volatility smile. Then what we're doing here is that we are taking the implied volatility vector and we are setting all the variables, the stock, the free risk rate, and then we are labeling here all the things that are gonna be on our graph, and we are going to graphic here first the puts. These are the puts for Microsoft, and we can see the move of the graphic like a volatility smile. Then we replicate this method using again the Black-Scholes model, and we can conclude that these ones are the call options and this one is the graph.
Now, to tell you how this is important in derivatives market, we can conclude that the volatility smile is an important tool in derivatives market because it helps to explain and analyze the behavior of option prices and implied volatility across different strike prices in the options with the same expiration date. It is important because it serves as an early warning sign of potential market turbulence, and risk managers can use the smile to assess the risk exposure of their portfolio more accurately, especially when they are dealing with more complex derivatives. And it influences also the choice of option trading strategies. For instance, option traders may choose to implement strategies that benefit from the differences in implied volatility between different strike prices. And these strategies might include calendar spreads or ratio spreads or butterfly spreads.